What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is January 20th of 2020. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's video, I want to spend some time to talk about what may be the most relevant topic, but also one of the most scariest trends that we've seen in traditional finance and banking over the last few years that signal a very big warning sign in the sense of liquidity for traditional markets. And it has to do with the Fed's continued operation in repo markets or repurchase agreement markets. Now, we've been talking about this back since September, but I think the picture is becoming much more clear now as to what might have caused this and what the key issue is that spawned this crisis in the first place. We're also going to be talking about why it's relevant for those of you out there who hold Bitcoin, gold, and silver, as well as those of you who may own equities and might have seen one of the best performing years in all those different assets. So we're going to be talking about this as we go throughout the video, and also talk about a really interesting tool that's become a new sponsored partner on the channel that's going to help us build algorithmic strategies to prepare and hopefully profit from these major shifts in markets. All right. So let's go ahead. We'll dive into the video, guys, but let's go ahead and start with a little bit of a precursor. Again, I don't want these terms to overwhelm you guys. I hope you'll stick through with this because it's really not that complex. A lot of it is massive finance jargon, okay? So let's go ahead and just kind of give a precursor here. So the date is September of 2019. We're taking a look back just a couple of months, and we saw a massive spike in what's known as the overnight repo rate. Now, for those of you who don't know what repo markets are, the repurchase agreement market is, to basically talk about it, the repo market is a market where banks are lending money to one another overnight. And this is basically to meet reserve ratios that are required by federal regulations, or to, get short-term cash for certain operations within the bank, right? The banks are going to hold nearly as little as they possibly can in regards to reserve ratios, so they can go and, invest in different products. They can make loans. They can do all kinds of financial operations in order to make a profit for their shareholders, right? Because of that, sometimes banks need to borrow money in the short term. And what happens is they exchange cash, or they're borrowing cash in this case from another commercial bank, usually speaking. And in return, they're giving something as collateral. So they're usually going to exchange something like treasuries, some kind of safe security or asset that can give them the ability to borrow this capital in the short term, so that if they go bad on the cash that they borrowed, the other bank, or the other trader in this case, has some collateral to cover for their loss, right? So it's just a way to exchange cash, very simple. And you can see here the overnight rate is very small here for the most part in the sense of its history. But we can see over time that we did see a slight rise in the rate here going into 2017 and 2018, with one spike here back in Q1 of 2019. But what really shocked the market was the overnight repo rate that went up to 10% here in Q4 of 2019. We had it happen in September of last year. So what led to this spike here, and what does this really say? Well, I think the important thing to ask first is, what does this tell us? It tells us that there was uncertainty that borrowers would be able to repay on their repo exchange in this case. That's why there's not as many banks lending in this case. People are expecting a higher rate if they're going to lend out. That means that there's a sense of insolvency, that there's not enough cash in the system to easily liquidly trade back and forth between these fixed collateral pieces like securities or treasuries, and also the cash on the other end. So it was kind of, to put it simple, it's like a Western shootout. Everyone's got their guns at one another. JP Morgan, Goldman Sachs are looking at each other, and they're going, who is insolvent? Who doesn't have cash in this case, right? And basically, if the repo market goes to a standstill, the financial system can collapse. If this is prolonged long enough, and someone doesn't intervene and fix this problem, it can continue to prolong and become a bigger issue. And that's exactly what the Fed realized. The Federal Reserve stepped in and started directly injecting repo operations to reduce this rate back down to levels we haven't seen since back here in 2018 and 2017. So we can see here on the chart here, they injected so far, and this is back in December, bear in mind, the number of operations has grown a little bit since then, over $320 billion of liquidity in exchange for supposedly safe securities like treasuries, right? So in this case, lending rates have gone down from that 10% rate that we saw in the chart down to a measly 2%, back to normalized rates. But this has required the Fed injecting a lot of operations here, basically a lot of newly printed cash that they printed overnight into markets. And since then, we've seen a big reaction from equities. We've seen the S&P 500, the NASDAQ, all these different indices continuing to rise as repo operations have expanded here. Now, we're going to talk a little bit about how this plays into the role of equities here. But before we even talk about that, or talk about how hedges like gold, silver, and Bitcoin have risen since then, I want to go ahead and talk a little bit about what caused this repo operation. What caused the Fed to intervene in this case? What's happening on the supply or demand side in this case for the overnight lending market that spiked rates in the first place in September? Who's responsible? It's a very interesting question. And finally, after months, we're getting a clear picture as to who's responsible in this regard. So this really has to do with basically what happened with JP Morgan, okay? I actually want to come back to this article in a bit, but I want to use this article first because there's a good precursor here in the sense of this chart. So we can see here across the board that repo operations have expanded as we've seen a decline in the reserves. So this red line here indicated this is produced by the Bank of International Settlements. Basically see them as the central bank of central banks. They are the head of the financial sector. And they produce a lot of great, public data here that people just tend not to look at. But you can see here since back in 2015, we've had a decline in the total reserves of the major four banks in this case, right? Oh, sorry, this is actually not just the major four banks. This is all U.S. banks in this case. Bank operations, even foreign banking operations, excluding credit unions, right? So the vast majority of retail consumer money in this case. And you can see that over time, the reserve ratios of those banks have declined steadily since back in 2015. Interestingly enough as well, if you jump back here, you can see how as the reserves have declined, you see the rate increasing over time. I haven't seen many people point this out, but there is a direct correlation in this because as the total reserves in the banking sector decline, this means that there's a liquidity crunch for repo markets. That means there's less available cash for banks to borrow overnight from other commercial banks, right? So a very important thing to bear in mind here, okay? So we already had this decline here over time, but going into 2019, we had a very severe decline here. And it was sparked by one major commercial bank that you all probably know very well. They've talked a lot of crap about cryptocurrencies, and they've also talked and touted about how great the economy is, yet they hold one of the largest silver long positions out of any commercial bank, and it's JP Morgan. Now, how does JP Morgan play a role in all of this? And, well, I got to say this, it's actually not that complex. JP Morgan realized something back a couple of months ago. They realized that as one of the largest commercial banks, they were providing a lot of the supply side for cash, in this case for repo markets. And there was a big demand from hedge funds. Now, to put it simple, to just give you a too long did not read here, and we'll kind of dive through the articles here in a moment. Too long did not read. The commercial bank, JP Morgan, was supplying a lot of dollars to the repo market overnight, to borrowers on the other end, which were hedge funds. The hedge funds were using these dollars in order to make highly leveraged trades on these very small trades between basically interest rate markets and different types of derivatives. The whole goal for them is to make small margins, but by trading it on margin, in this case, basically borrowed capital, they can make pretty good returns if they make a positive trade. So there was this huge amount of demand from hedge funds in this case, taking very risky trades, in this case on excess margin. JP Morgan pulled their cash out of this market, the repo market. They basically took cash off their balance sheet that was being lent out in repo markets and bought a lot of long-term bonds. And along with that as well, they've been going through and paying a lot of cash out through the form of dividends or repurchasing their own stock, as we've talked about through stock buybacks. They have had record amounts of stock buybacks as well as dividends to investors, and this has propped JP Morgan stock up excessively in the market. This is what most companies have been doing. They've been using excess cash here to prop up their own stock and, again, continue to pay out higher dividends. Well, this led to a massive supply shock at a time where demand is growing up excessively through hedge funds, and basically put the United States in a position where it could have seen one of the largest shocks to the financial sector, not only since 2008, but for a long period of history in finance in the United States. So that's the general summary here. There was a huge set of growing demand here from hedge funds making these risky positions that would have had a huge mass liquidation if they couldn't have gotten access to cash. And JP Morgan went out, paid its shareholders some of the best dividends and stock buybacks it's ever done in history. And along with that, has reallocated money into a lot of different types of securities or long-term bonds versus the loan market where they had a lot of their exposure. So that's the general summary here. And we'll basically see how JP Morgan realized it could hold the Fed hostage. It was able to showcase that, hey, You know, we were the major liquidity provider. You better step in and start injecting liquidity into the repo market, basically providing more easy funding money into the economy. Then if you don't, well, the entire system's going to collapse. And the Fed doesn't want that, of course. So the Fed started injecting short-term repo operations that it keeps on rolling over and continuing to grow in order to provide liquidity. And now they're starting to consider providing liquidity directly to these hedge funds for these positions. And this is exactly why equities have continued to rally. It's why JP Morgan and other stocks across the board, why the S&P 500, why the big tech stocks and the NASDAQ like Apple have continued to rally, because there's so much of a guarantee that the Fed is just going to propagate easy money into the market. So let's go ahead, let's dive through this article. I've got a lot of pieces highlighted here. So according to the overnight report from the Financial Times, which confirms that we've already disclosed previously here on Zero Hedge, namely that JP Morgan pushed more than $130 billion of excess cash away from reserves in the process, significantly tightening overall liquidity in the interbank market. The bulk of this money was allocated to long-dated bonds while cutting the amount of loans it holds. So we can see from the chart down here, this chart kind of summarizes it here. They're basically moving money out of their lending market, moving it into securities or long-term bonds. Now, again, this sets a precedent where there's a big shock in dollar liquidity for the interbank market, for the repo market. And at the same time, as they declined and shrunk their loan portfolio by about $40 billion, they started selling off mortgages. The bank also reduced its amount of cash in this case. Now, again, the goal of this case for JP Morgan is obviously to position itself well in the securities that it purchased, but along with it as well, to have cash on hand to be able to provide its shareholders with tens of billions of dollars in stock buybacks and dividends. Now, let me just go ahead and put in perspective here what JP Morgan is planning to do this year in 2020. They are planning to provide more stock buybacks and dividends for their shareholders. That may include themselves as board of directors of the company who are making these decisions. They are planning to provide more dividends and share buybacks than their expected profit for next year. Let that sink in. They are expecting to basically spend more than they're expecting to make in income for the entire year for share buybacks and dividends. That is absolutely unheard of. It is insane. It doesn't make sense. But they know they're going to be able to get away with it because the Federal Reserve has started to play catch up. After years of reducing, actually really about a year and a half here in 2018 and 2019, where they finally started to really reduce their balance sheet, the Fed is stepping in and providing easy liquidity. They're providing what's known as not QE, basically these repo operations. And really, it's quantitative easing, just in a different format, in a different market, right? So we not only see JP Morgan, pressurizing themselves. You can actually see that JP Morgan was directly responsible here. They basically pointed a gun at the Fed. JP Morgan's government-only money mutual fund begins pulling money out of the overnight funding market. So you can see here that they pulled it out, and that's what led, again, to the spike in repo markets here in September, which is the white line here. You can see that it led an absolute shock on the overnight interbank market. And this is a very, very scary trend here where the Fed felt it had to step in. And every day you can see that JP Morgan has been the one who's been picking up these operations and swapping them out for treasuries. It's very, very fascinating. And again, leading to the squeeze here on overall reserves. JP Morgan is playing a big role in this continued decline here. So what does this mean here? Well, if it means that the Fed is going to step in and they're going to start providing dollars directly to hedge funds, well, where are hedge funds most positioned? Equity markets. Equity markets. They're taking high risk positions in equities. And this is what allowed JP Morgan to continue rising their shares, because now that they have more cash on the books, they can keep propping up their stock. But it's not just JP Morgan. It's the broader equity market, right? We can see here, since back here, since we had the inversion of the yield curve, we've been able to have a rally of nearly 25%. We're almost getting up to the average that we get after the inversion of the yield curve. And the Fed has done this over the last few months and last few weeks, continuously having green weeks here by continuing to further expand repo operations. The more signs they give that easy liquidity will be injected in to the system, people are getting more and more confident of buying assets. They're even getting so confident that they're buying Apple stock, which, bear in mind, week after week has been going up, and at a faster and faster rate here, even after it surpassed $1 trillion valuation back here in September. The reason they're doing this is because, quite frankly, companies like Apple are profitable. They already have massive share buyback programs, which you're betting against if you're trying to short or sell the company. And along with that as well, you've now got all this funny money going to hedge funds, where they can invest it any way they please, right? They can keep taking more risk. This is exactly what the Fed is doing. Whether the Fed realizes it or not, I think they very much realize what they're doing, because they found themselves in a bit of a catch-22. If overnight, commercial banks, these major 4 banks that have dominated the commercial banking sector, the Fed plays a very big role in this consolidation of the banking sector. If they continue to reduce their cash, the Fed needs to play a larger role here to make up for it. And they're basically taking any step necessary, even going to the extent of providing hedge funds directly with more cash, when they should slowly but surely say, hey, newsflash, get out of those risky positions, stop trading on excess margin. They're simply allowing the system to continue as is. They're filling the punch bowl with more alcohol. So it's a very interesting situation here, guys. We have never seen something like this in a very long period of U.S. history. It's very Roaring '20s-esque of the United States. We've never seen this kind of risk-taking in a long period of time. And along with that as well, you can see here since back in November, right, we've started to see a very drastic correlation between Bitcoin, silver, and gold here. These hedges are starting to react because there's not only a very big sense of caution from those who truly understand what's going on, but with this new injection of liquidity into the system, this cash that the Fed is printing, and the course that the Fed is taking of printing even more here over the coming year, maybe for directly going to hedge funds, it makes sense for these different hedges here that hedge against excess inflation, excess printing of money, for them to go up. So I will say this, if you guys are positioned in these markets, again, I don't want to make any guarantee, but at least these markets seem to be serving as a hedge against what central banks are doing. It's predominantly the Federal Reserve. But don't doubt for a second that other central banks aren't going to copy this game sheet. And this is going to go across the board here. It's just another step here where the Fed is slowly but surely becoming Japan, which Japan has basically gotten directly involved in purchasing equities. Whether the Fed directly starts purchasing and holding equities themselves, they're going to start to exchange cash into hedge funds. And hedge funds are they're heavily exposed in equity markets. So again, this is another way where the Fed is propping up asset markets time and time again, like they've done for the last decade, in the longest economic expansion, one of the greatest economic expansions we've seen in equity market history. So it's good to position ourselves in markets like cryptocurrencies. I hope you guys really enjoyed the general kind of topic we had, but I want to spend some time to talk about this really interesting platform that's one of our recent partners here on the channel, and that's Clio. And Clio is a really interesting tool that I think will help prepare us during this time frame where we're starting to see repo market operations continuing to spend like they are, and also seeing markets like cryptocurrencies emerge, as well as being able to build hedging strategies for equities. Now, long story short, for those of you who may not know, here on the channel, I was originally going to pursue data science. You might be able to know from the name, or notice from the name Data Dash, that I was originally pursuing a career in learning Python, learning R, all these different programming languages to build algorithmic trading strategies, to get into building algorithms for all kinds of interesting kind of data science markets. And for the longest time, I wanted to learn those languages. And sadly, when it came to the channel growing, I didn't find the time to actually go through and learn those languages. Not to mention, I'm just not very good with programming, to be honest. And Clio is a really interesting tool to kind of fill this void in this case of being able to build algorithmic trading strategies for a variety of different markets, from cryptocurrencies to equities and forex, and not have to know a single line of code, to put everything in plain English and a clean user experience. And I've gotten to know the team here over the last month or so, and I'm very impressed with the product they've built over the last year and a half. So I want to go ahead here and just kind of give you a quick tour of what they have. And the nice thing is, if you guys want to go ahead and test this after the video, feel free to jump over to Clio's website at Clio.one. It's actually free to test out. You can try out their platform, and you can also plug in manual trades. It'll be free forever in the case of plugging in manual trades. But the whole idea is they provide the ability to process automated trading strategies where you don't have to stress, where you can pre-build them, you can back test them, and get a feeling as to how your strategy is going to approach markets and how it's performed in the past. So I want to go ahead here and look at one of the built strategies here. that I have on my account, the Alts Volume Strategy version 4. So this is one of the pre-built strategies here on the Clio platform. And to just kind of walk you through how this actually operates, you'll see here, there's no code. There's nothing that's too overwhelming. It's just simply a nice layout here where we can build automated trading strategies. So the first thing here is to understand what market we're trading here. So basically our strategy settings tab. So this allows us to know that we're trading in this strategy a crypto market. We're trading on Binance. We have an initial balance of 10,000 USDT, so that's our currency pair we're trading. We're on a time frame of 1 hour, so our strategy is going to be looking every hour here on the chart of the given assets and what we're looking to trade. And along with that, we're back testing this trading strategy through a period of July 14th of 2017 to the 15th of January in 2020 with a 1-to-1 leverage. So we're not trading with any leverage, we're just trading with our base capital. So we can see here that across the chart, we set very simple in plain English rules. We can say when Bitcoin dominance is above 50% and crypto total market cap is up by 1% in the last week on an hourly time frame, again, where we're checking every hour, then we want to buy Bitcoin to a pair of USDT. So we're using our USDT to buy Bitcoin. And we're using 20% of our balance with a stop loss of 6% at the market price of where we bought it, with a trailing take profit of 8%. So if we go up 8% in this case, so if we continue to rise up in this case, we will continue to have a trailing stop loss in this case to take profit of 8%, with also a trailing 1% stop loss. Now outside of that as well, what's cool here is that we've set a full rule here within the strategy. We had an open condition, right? We have what we're looking for in the market to open the position. We've told it to buy Bitcoin in this case. We have a condition close and also a stop loss. We've set the asset and volume we want to buy, right? This is really great. We've basically built a full strategy here, but this doesn't have to be it. In Clio, we can actually have multiple rules in one strategy. We could also want to buy Bitcoin if alt's total volume is down by 2% in the last day. And we can also set close positions as well, close rules. And set it to where if Bitcoin USDT is up by 10% in the last week, then we can actually close out of the position and take profit, right? So there's a lot of really interesting and fascinating stuff that we can set here. We can have multiple rules within a strategy, and not to mention, we could trade multiple assets in each of these rules inside the strategy. It's really fascinating. And not to mention as well, just to go here, we can actually go through some of these conditions here. They have so many different data points to choose from. And one of the cool things I like are the crypto fundamentals. So one thing that you can't access in TradingView and other trading applications that you can get here in Clio is a vast amount of data sources from APIs that they pull, where we can actually get market dominance for specific altcoins, for specific market capitalization of cryptocurrencies. It's fascinating how much data we have to work with here, and you can build some very interesting strategies here. So we're not just stuck with Bitcoin dominance or total market capitalization. We can dive into data points on specific cryptocurrencies, which I think is just too cool. And at the end of the day, too, you can actually use Clio as really your all-in-one platform here for trading activities, whether it be automated or manual. You can also place manual trades here. After plugging in your exchanges, you can do live trading or paper trading across pretty much any pair on these exchanges that you use, from Binance to Coinbase Pro to Binance US. There's a lot of interesting exchanges you can pull from. So I can make a trade here from ADA to BTC. If I had Bitcoin in my portfolio, I could choose the volume here. And just like in the automated strategies that we build, we have to select whether or not how much we want to trade. We have to select the stop loss and take profit. What's nice is there's a lot of different features here. We can trade an exact amount of units here. So maybe I have one entire Bitcoin that I want to trade. We can also trade a percentage of balance. Maybe I want to trade 50% of my balance of Bitcoin in my portfolio, right? There's all kinds of interesting things we can do here. After we confirm that, we can choose what market price we want to set here for a stop loss. We have to make sure to have a recommended strategy here in this case to get out of the market if things don't go the way we planned here, if things go south. So we can set a market price, maybe for example, a certain amount of Satoshis for ADA, or or we could set, for example, a percentage decline here, percentage change to the downside for our entry into ADA. Maybe if it drops 20%, we get out of the position, or percentage of the balance here, when your balance changes to a set percentage, right? So there's all kinds of interesting things we can approach here, but I usually like to use the percentage of market price to keep it simple. And we can also specify a take profit. In this case, I would just go basically simple and again use the percentage of market price. So if it goes up 50%, I take profit. That's a favorable risk to reward ratio of 50 to 20%. I click confirm and I can click buy and open a position just like that. So Clio keeps things very simple here. Not to mention, as you'll see here, the user experience is very clean, and we're going to be spending some time here on the channel going through on our journey here and building out some automated strategies. As many of you know, we've created the SMS strategy that takes in the squeeze momentum indicator, the stochastic RSI, and also the MACD, the weekly time frame. We're going to try to build that here on Clio, as well as do all kinds of other interesting strategies to build automated strategies that keep us from having to stress about markets and guarantee that we're not going to have emotion inside our trades. It's the biggest downfall for most people, is that they do things manually and they allow emotion to get in the way of their strategies, guys. And that is not something you guys can afford to have when we have such an interesting set of opportunities on our hands, when there's such interesting macro factors here that are propagating markets to excessive highs in the sense of equities and are eventually going to lead towards a massive devaluation of the dollar, a massive decline in equities as we've propped up markets excessively high in the longest economic expansion and the greatest economic expansion on a percentage basis in history of US markets. We're talking crazier than 1920 levels. We are in the new roaring 20s, and ironically enough, it is 2020. So anyways, I hope you all enjoyed this video. I hope you all enjoyed our analysis not only into traditional markets but also into the Clio platform. I'd recommend you guys give it a try, but also do some research into this interesting news. And if you guys have something to say about it, leave a comment down below. And if you like the video, hopefully you can drop a like. I always appreciate it. All right. Hope you guys are doing great wherever you are. I always love talking about this stuff with you guys. And like I mentioned, I want to hear what you think down below in the comments. But until the next video, I'll see you all in the next one. Have a great day, everyone.